Okay, so there are two plays that we're going to cover. This is our learning objective, 2 plays in 1 model. Hold on just a second. Okay, so, sorry, I got an email from Mr. Sender. An email from Sender. That's funny. First time I got it, I junked his email. Actually, he wasn't a spammer, and it came in, and then it kept saying Sender, and I kept sending it to my spam email. I read half his email, so it never got there. Anyways, sorry, I had to pause. So, learning objective. There's 2 models, and we want to accomplish getting our 2 models, we need to cover charting relationship to money management profiles. So, under charting, we have some rules. Support is an upward movement in price. We're missing the word upward. Upward movement in price. Upward movement in price. Axiom 2, this is just a generally accepted rule. It is a trend. It's defined as a break above resistance or below support and starts on a low time frame. Axiom 3 is momentum can be expressed as a distance between points. R1 minus R2 has to be greater than R2 minus R3. This is an increase in momentum in the trading range. H1 minus H2 is greater than H2 minus H3 is an increase in momentum in the candlesticks. Okay, this becomes important. Now, there are 4 types of charting here. A fade is to sell high and buy low. A breakout it's an easy trade. I'll show you that. There's a retracement within a trend. And then there's one called slowing momentum. This is a type of trade. Okay, I want to pull this up on the same page if I can. It's only 1 line down because I like to keep these types of trades in here. All right, so these are types of trades. Charts, excuse me, not trades. But they're going to be really important when I cover something here in a minute. Okay, we're going to come up here and we're going to bring up a chart, and I am going to grab it. We're going to open this, and it's a very specific item that we've set up, and it's some charting stuff. I'm not a big Elliotician, but I classified this under Elliott waves. Okay, I believe that's the name I gave the document. All right, and it'll pop up, but there'll be some interesting information that we have to cover. All right, so we're going to come up here, and this is going to get into time sliced and event sliced data. First off, a fade is when you sell a high or buy a low. A retracement is denoted by the box, is when you pull back within that trend. So a fade plays for the retracement. A break pays for the growth phase. Now, a retracement plays for the recovery phase, and I'll explain that in a minute. Slowing momentum is what we just talked about. It's an increase in momentum. All right. One of the things we do on a fade, I'm going to draw a fade over here off the screen, and I'm just going to show you something. Whenever you see me draw dashed lines, normally it means a future price movement. Okay. Usually. Okay. So what I'm going to do is I'm going to draw a candlestick. This would be candle momentum, and it would tell us, it's a trade identification technique, but it would tell us that the trend is ending. Well, isn't that the same thing as this? This is slowing momentum. Slowing momentum causes divergences. Slowing momentum could be called a divergence. I wrote a paper about that. But if we come back down here and we look at this, here is a breakout, and it's denoted by the dashed line, just like we did up here. Okay. A fade is denoted by the circle up here, and a square is the retracement. Now, this just shows you that we need to learn a trade, a fading trade, a retracement trade, a breakout trade, and a slowing momentum trade. Slowing momentum is denoted by the black. Well, if you look at this, you've got a buying phase, selling phase, buying phase. That's basic Elliott wave. This, though, this is a retracement phase, a recovery phase, and a growth phase. The reason the retracement's up here, the retracement, you're playing a fade to a retracement to a recovery, and then the growth phase. This is how I think of the market. Now, why is that important? Really, the main learning objective comes in here. Okay, a fade is to sell high and buy low, but the money management, we're going against the trend. So what do? We need a risk-reward ratio of 1-to-1 or an equal distance stop and target. So our money management profile would always demand, and what is the money management profile? We have it down here. We defined it in some terms as size is L, target is T, and S is stop. What can we change in this? Well, we already know T and S have to be equal. So we just made an inference in this. We said, well, it's going against the trend. T and S must equal. Okay, Now, if I come down here and I say, well, let's take a breakout. Well, this is an easy trade. The money management system should work like this, all right? Let's put fade in here. We'll highlight this. The money management system should say these breakouts, and then a pullback is what's happening. They're short yard plays. You need to be quick to exit and tear out. Okay, you're going to break out, but it's already moved up some. You're not expecting it to go forever. They have a high probability of winning, so it's okay to increase L. And I'm going to highlight, these are money management systems document. Oops, let's grab that back. Excuse me. I was trying to hit bold for L. And so we're talking about each one of these. L is size. I don't want to say equal size. I'm just going to put a hyphen there into our document. All right. So if we trade a retracement or a pullback, which is the same thing, retracement, pullback, the money management, usually this is going for a large win. This means you can increase T, but you can never increase L. Never increase L. Never increase L. I wouldn't do it, usually as a rule of thumb, because what happens, let's don't say never, let's just say try not to increase L. Try not to increase L. What that means is that I'm not going to increase my size at all. So I may lose more often because I'm going for a bigger target. Tier into positions. Usually this involves seasonality. Now seasonality is a form of time slicing. I'm going to show you that first in the graph here. Okay, seasonality is right here. Okay, seasonal on corn. This is October in corn. Well, it has a big drop, less of a drop. It's got a monster drop right through here. Okay, and it's got a really big drop right through here. All right, so we're going to bring this in, and we're going to look at something on this. Now, we're going to take this, and we're going to come down here, and we're going to bring this in, and we're going to say, you know what, with that big drop, less of a drop, it should break and run up till June. Well, in June, it gets the opposite pattern. There's a huge run because you ate the corn all winter long that was in the silos. You couldn't grow it. It's cold now. And there's less of a run. Well, that's seasonality. It's also time slicing and event slicing all in one. So what I'm going to do is I'm going to show you an aspect of that. And what I have up here is I have a chart that I've set up. This is the S&P from August till the end of the year. So I'm just going to make a generalization. Now there's some really cool software out there that analyzes this. It's $5,000. It doesn't look too hard to program, but it's called Best Choice Software. It looks really awesome. Some of the software I like is Advanced Get is probably my favorite software. And then but it uses a lot of Elliott Wave. This Best Choice I've never owned, but it looks really good. So what I'm going to do is I'm going to come back into here, and I'm going to talk to you a little bit about we've had this seasonality going up, and I'm just going to take a picture of what we did. That's what we took a picture of. Now I'm going to come back in time, and this is what one of my clients did, because Best Choice is kind of pricey. She took and she would take this and put in different months and say, well, what did this one do? What did this one do? And what did this one do? And oops, we want actually the Snagit setup right here. I'm thumbing back to find it right there. That's the Snagit editor. And she said, you know what? She just cut them out. And this is the same time, different years. Well, that's the same pattern. That's the same year. My bad. It wasn't the same time, different years. Let's grab this one. You can go through here, and this is time sliced by year, and this really involves stocks, and it's one of our edges, one of our trading edges is to grab this. Okay, now we got this one on the right screen. This is a real edge in trading, a really good edge in trading is to take this and look at it. Why is that going in twice? Oh, we've got them in here. There they are. Copy this one. I was copying it and pasting the same one in on it. That's I see the error I was making. So yes. Okay, now let's pull this one down. Okay, so here's the two of them against each other. Okay, here's 1 year, and there's the other year. The point is you can print these out, put them on flashcards or whatever. This is data that's sliced together by time. So this is August to December, August to December. Well, you can look at that. That's one way to do it. Now, There's another type of time slicing which is more indicative of in the morning. 6:30 we have a breakout if there's news. So this is all dependent on news, and that would be event slicing. Then there's what's called the fair value trade. This depends on how much the commodities moved. If they didn't move much, this trade won't happen. That's event slicing. Then if it moved a lot at 8:30, it'll pull back, which brings me to a little side note. If we go into here and we look at in our notes, I'm looking for the Google Doc now. We added something in here that was kind of interesting. We said right here, as we got into a retracement, this is a trade identification skill set of a retracement. We could do something. Okay, is that pasted in there twice? It looks like that's in there twice. Look, this we must have moved down in the list in here. Learning objectives, charting axioms. Well, let's take that out. It looks like we put that in there twice. I didn't notice it, that we had it in there twice. We're going to pull this up. I'm going to try to pull this up on the same screen. This is slowing momentum. It's a different one. It's one of our charts. But our document got a little wonky here. We're fixing a wonky document. We're going to pull this out one so you can see where it is. There. So we're saying a trade identification skill. A long breakout usually means a bull pullback will be awesome. So if we, let's get over to our drawing tool and we say, you know what, this broke out and this thing just ran up a long ways. The farther it ran in comparison to the previous range, and this is something that can be programmed easily, that's the previous range. So that's a small range. The farther it runs off the small range, the bigger movement we're going to get off the next range. Okay, so this is a huge movement off the next range. So if we have this little range right here, you get a big range. A big range is followed by a little range. So a shallow retracement would come in next. Little range, big range, shallow range. Okay, so now if you do that, you want to look for a large run. It's something that helps your pullbacks. We just threw a random note in here. Trade identification skill, random note, because we're not really dealing with this right now. We're dealing with money management profiles. So let's recap this and summarize. Fades, we go for an equal distance stop. Breakouts, we can increase L because we have high frequency of win. Now this becomes important. The frequency of win we're going to deal with here in a minute, or the frequency of loss. Now that's super critical to get. Otherwise none of the other systems work. The money management systems can't work without that data. Usually if you're going to go for a bull pullback, you're going to increase the target because you're working on something else. Now, these, we'll just put a money management system in here. These usually work off of an R and R to 1. And let me give you an example. They actually sometimes can work in upside down ones. You know what I do with these? They have a backwards R and R. So let's put slowing momentum here. I usually sell bear calls on these. Okay. So the money management profile is upside down, upside down, upside down. More risk, more risk, more risk than I can win if I do OTM calls off that pattern. So it's a big run, less run. It's at the top. Usually what I do is ITM calls. ITM calls because R and R is 1. R and R is 1. It's a little bit better. So I do some of this. So let's just change this. I could say I could do a bear call. This is a tradable instrument talk right here. We just threw something in. I could do a bear call, which is a tradable instrument. Then I can win. I can do a bear call OTM. Let's rephrase this. I can do a bear call OTM above resistance, above R1, and wait. But R and R is backwards. R and R is backwards. So what I do is I do ITM because ITM calls R and R is even. So the proper course on these is when you're picking a top is even R and R. R and R or equal distance stop and target. Equal distance stop and target. Okay, this is the thing to get to. Now, as we get into this, we're starting to build into this and coming up into it. We've covered all the way down from the top, some different patterns, some different charting. Charting's relationship to money management is important. So I have to summarize this one. It's that important. I'm going to come in here and go summary. Fades have a equal distance. Fades, we'll just put it like this. I hope you can get this. We're going to say target T equals S. Retracements. We're going to say L cannot be increased, and S, let's see, L cannot be increased, and T can. Breakouts, it's okay to do this. L can be increased, and T cannot. Okay, and then we have slowing momentum. L and let's see, T and S equal. Okay, that's our summary of that. And those matter on patterns, and there's specific reasons for that. It's because we're going to be dealing with overcoming loss. Okay, and this is one of the ways that we do this. We look at our money management systems on here. So really, how do I overcome loss should move right to the top. What am I trying to do here? This is one of my major learning objectives. Is I'm going to put this up here. I'm going to say, how do I overcome loss with patterns? That's one of the things I want to know. So we just put some side notes in here, trade management. Now, how am I going to size the trade? Okay, this is one of the things we have to deal with. You input. This is a user input. You input this. How am I going to size the trade? Okay, this is trade sizing. How far does it move? Well, to figure this out, we have to go into time sliced data, time sliced, and event sliced data. Okay, now to understand this, we're going to pop back in here. Let's make sure that this didn't make the system go all funny. We'll put the retracements down here, and let's grab this one right here. So we haven't got down to the other notes I've got here. So we will, I guess I can highlight those. They're right here. We're going to say our trading edge. We try to get this every model. What's the edge in the model? Seasonality. And working two types of trades is going to be an edge, a long-term trade and a short-term trade. That'll be an edge. It's how we work our dispersion zone, and time of day is an advantage. Time of day. And when I explain this to you, it'll be a lot easier. So, well, let's just say that I was going to trade corn. I'll give you a written example. I'm going to trade corn. I am going to trade corn. Going to trade corn. And I buy 3 calls. And it moves, and it moves, and it moves. Sell one. Sell some of it, or change the trade, That is a short yard play. Pay for the long-term play. So we're going to keep some for the long-term play. Keep some for long-term. Because we're going to win big if that goes that way. I mean, we're going to win tons. You ever had something go $30 into the money? Awesome. It's a lot of money. It's more than just what you play for on a daily basis. Okay, so workflow. Find stocks that move at a certain time of year. Okay, that's what we're going to do. Okay, we're going to find stocks that move at a certain time of year. We're going to get into it. Now, this how to overcome loss, we already put that up there. We already got the trading edge. Looks like we had pasted this in here twice. Now, let's go back into our document right here. And we said, look at the time of day. Well, I want to show you time slicing by day. Okay, so what we're going to do is we're going to change this now, and this is time slicing by day. This is the pattern that I'm expecting if there's news. Yellow's neutral. This is 5:30 in the morning my time. Blue is when it should be breaking out. Red is when we look for a retracement. Black is where it heads to the bank close. So if I was to color code this and put them on, yellow is neutral. We're not trading. Before news, sideways. That's the yellow, okay? It's before news and sideways. And I probably should change the font color on there to yellow so it matches. All right, so that's close enough, lime and yellow. You can't see it very well, but then the blue is when we're expecting a breakdown. Okay, this is when we expect a breakdown. Now, then we've got back here, we have on this section right here, we have our retracement. Our retracement is expected in the red section, red. And then we get our bank close in the black section, bank close. This is the pattern we're expecting. Now, the more it moves, so what causes this? This isn't in our notes yet. What causes this to move and what makes it move is important. We threw a little side note in here for trade management. We're going to drive the breakouts down. We're going to put in another little side management thing under breakouts. We're going to say this. A trade ID skill set, trade ID for breakouts. What can help us? Breakouts. We need trading tools. Trading tools. What tool can I use for breakouts? You know, all the indicators, this is something I've been dying to get a hold of Robert and really chat with him about, but all the indicators are really designed to be oscillators. There really aren't any, there are no good predictive breakout tools in the whole realm of technical analysis. I know that. So there's a reason for that. On bars, we have only open, high, low, close, volume, and either the beginning timestamp or end timestamp. Okay, so we have timestamp, which would be 7:05 a.m. Okay, we do not have anything in between there. So what we can do, indicators do not focus correctly on the one side of the equation. They're errant. Okay, they're totally errant. So if we come down in here and we say, well, what kind of trading tools? Let's first define what defines a good move. What defines a breakout? Okay, a breakout. All right. So what defines a breakout is really a cross above R1, across above R1. But what makes it travel more? What makes it travel more? What makes it move more? Well, we know some of it. We know news makes it move more. So we could say news. This is an event. So we have events, which would be news. News makes it move. Okay. Correlations. This is some we started talking about. A correlation can define this. A big correlation move. A correlation move. Something we haven't talked about yet too much is what's called a it is a correlation move. It's called the fair value move. Fair value move. Okay, this can cause things to move, but what else causes them to move besides news? And besides that, well, time of day, like the opening of the market. But what else? Well, there's two things that can define it. Three. We're going to introduce three variables. Okay, one is how fast the bar forms. How fast bar forms, and that's with your eye, bar forms. How far it moves compared to time. And we're going to say location of S1. Location of location. And we're going to define location as this. It's going to be close minus S1, and then it could come out negative, R1 minus S1. That'll give us location. So if we have a shallow retracement, it could denote a move, because look at what we're trying to figure out. How far does it move? Now, we could do one more thing. Compare this. Compare to other instruments. Compare to other instruments. But we need a level now. Instruments. What level triggers this? What level would trigger this? Would trigger the move? So how far away does it have to be trigger move? Well, the fair value one that comes up, this is all computerized. It's well known. This can be had on www.indexarb.com. You could read some articles about that. But really, what is going to trigger the move? Well, we could do some correlations with other pairs, and we could get overall movement. There's some fancy things we could do with some data, but you don't have to do a ton of them. I could give you a sample. This is for a programmer, but this is a little sample of what you could do. You could say this. This would be called a pivot a pivot into a pivot breakout indicator. So watch this. We could add some things to this, and I'm going to pull this up. So what could tell me that the move that we're anticipating is coming? Now we could time slice this. Look, they're all back here, and look at it. You need to know if there's an event, like a news event. There's a good one. News event came out. News event came out. These are, look how many are trending. Okay, it's neutral, break, pullback, trend, reverse. Black's the reverse. I mean, if you time slice these, they all look pretty decent. Okay, there's one time slicing. This is a time slicing one, and it just depends on news and how far it moves. Here's another one where you've got it. So you've got in here, you got a breakout. It failed the breakout and then shot straight back down going the other way. Well, this is what we're going to deal with in just 30 more seconds, and we won't be able to get to the model yet. Okay, so what we do is on our breakout, this may be a way to denote some stuff. Now, you would have to have like an API from Thinkorswim to do this, but they probably wouldn't even allow this. They only allow you to access so many bars of data. But I'm going to do something right here, DEV, DEV, and we're just going to do pivot, DEV, pivot indicator, pivot indicator. Okay, so what we're going to do is we're just going to do something real quick. We did this earlier. I did this earlier. We're going to go R1 equals resistance. And what, oops, I got to grab this. R1 equals, and I'm going to call something security. This is, we're going to look for the word security. We're going to grab a different security and compare something. Okay, so security. Let's go grab this. I'm going to grab something in here just to show you. Okay, now all this is going to do, it's going to say, hey, Jeff, grab me a different instrument than the one that you're sitting on. That's all it's going to do. I'm going to say online, and I'm going to say go look for CVX, because CVX, we're looking at the S&P. That's what's on my screen. Look for CVX and look at the closing price. Just give me, not the closing price. Let's get resistance price. Okay, we're going to get resistance. So we're going to say, hey, give me CVX resistance. All right, and this command would be 1 would be the current resist. Well, that 1 is the type of pivot. 0 is the location, the current one, and then 1 is what time frame. So we grab this R1, and we grab this, and we're going to bring this down, and we're just going to put in S1. Okay, S1. All right. Now we're just going to do something real quick. We could basically say, when does CVX? Because we're on the S&P, we could change it. We're just using, we could change this to whatever we want. So I probably should have went to CVX and then done S&P. So I'm going to put this in. I'm going to call, yeah, I'm going to do it a different way. I'm just going to slightly do this ESC1 because this will be more useful to me in the long run. You could take ES, which is the S&P. Okay, this is the S&P right here, and you're going to pop this up. Okay, now once you got that, we're going to go compare this to the one that we're on right now. So I'm going to call this R1 SPY. SPY and SPY. Now, all that is going to get me that price. I'm going to come in here and I'm going to take R1 and I'm going to say, computer, give me resistance right now. And then come down here and give me support. Okay, now give me support and I want to know something. Now, you're going to look at something. I'm just going to take and I'm going to say if sub the high of the bar, and we're going to need 2 more things up here. We're going to need just 2 more real quick. SP high and SP low. Okay, SP high, so high, and SP low. Okay, we're just going to say something. Now, this will be really, really, really simple. We're not even going to put this in. We're just going to say, computer, give me the low. Matter of fact, I don't want you to have to watch all this, so I'll get it done, and I'll turn this back on. Okay, I quickly made that. All it's going to do is, if we, well, I'll show you. We'll just click OK. It's just going to come up here and say, are we crossing above resistance? Are we crossing above support? If it crosses above resistance on the SPY, give it a 1. If it crosses above resistance on CVX, give it a 1. So we're going to just display this as a 1. Now, it's going to say, hey, did I go above resistance or below support, or what did I do? So I'm just saying, hey, tell me which way it's done and which way it's going. and this is S1. Oh, it's just S1. It's this low SPY. Okay, that should be right there, and let's just click OK. Okay, now I have to bring up another chart before I bring this up. I'm going to bring up CVX. We want something that it's highly correlated to. Now, why am I bringing this up? Why did I take the time to do that? Just to tell you that, teach you a little bit about correlation and momentum. Okay, so I'm going to bring up right now CVX, and I'm going to drop this on the screen. Okay, now CVX should come up here in just a second. Now I'm just removing this, and we already know this just tells you if it's correlated or not. The correlation index up here, I just got to make sure it's set up to CVX. That's to oil. We just had CVX correlated to oil, but so it's highly correlated to oil. We could use USO in our example, but we didn't. So we're going to bring this up, and we're going to okay. So what we did, this shows you momentum. Now look, this right here is a breakout. And sure enough, it's a breakout. We're going above resistance. This right here is also a breakout on a different symbol. So do you see how close those are in time? Okay. So what this does is this displays a breakout on both the S&P and CVX, which S&P and CVX, they're highly correlated to each other. Well, because those two broke out at the same time, look how far it moves. So let's go look for really tight spots that we could come in here and check it out. Now, right here, those are really tight ones. And for day trades, this is a multiple. This is 5, 10, 15, 20, 25, 30, 35 minutes, where those are right on top of each other, almost breaking out. But that's 2 in the afternoon. See how slow they were? So if you just take these within the first hour and say, computer, now don't show me these unless they're within the first hour. You can just look at it and come back here and say, actually, let's apply our little template here, and let's see if it'll draw on. This requires a lot of oomph from my computer, but we could actually time slice this because we laid out all the codes. I'm just waiting for the computer to catch up, and it might not be able to do it. We have it done over here on one of these other symbols right here. See where it's time sliced? We could, and it's got the color coding. We could put that on there. I'm going to close those charts right there. It'll just give my computer some more speed for a second, just because we've got too much going on it. And I can bring this up and snag this in. We'll see if it comes in. I think you get the point. So let's capitalize on this. So one of the things we could do is to say, well, let's summarize this. I put in a little sample, but I'm going to summarize something in here instead. I showed you the sample in the software. So the summary is this. Breakouts can be guessed at, or breakout strength. We have no good indicators. There's no good indicators. No good indicators made. If you guys can think of one, tell me one. I've never found one that was super good for a breakout. Okay, because it causes all the indicators to go into overbought statuses. But that's the real growth rate in the market. So indicators fail. So what we say is time. Time is one. News is one for bringing it back in. Time and news, and then we could say events. It's certain type of events could do it, and correlations, and speed of breakout Now, you can't do this in here, and I don't even think you can do this. There's a formula that you can actually use, and I'll have to show you. It can only be done in like a TOS type API that can give you some momentum. And I showed it to Robert. He can look at it. Tonight, I showed him a little sample of it, and it just says, hey, it's really the speed of a breakout that it has, and it goes through. Okay, so our trading edge is time of day and that, and maybe the indicator I did, the distance in time between the two breakouts and time of day denotes strength. This is a really critical trick that I just pulled. We take highly correlated instruments, and when they pop, it brings them together. And that is something that I can set up and do. It's really a good thing. It's the distance between each of the breakouts that it grabs, okay, on each of the symbols. All right. Now, Those are good things to do. They're just super good things to grab, and you can catch a breakout on it. Now, I'm going to pause one more time. Sorry, I had to cough. What we need to bring up now is frequency. I need to bring up frequency, and I need to talk to you about a frequency of loss, and then we can get into the model. Okay? So one of the things I'm going to bring up again is I'm going to bring up ESC1. Okay? And we may have to break this down into 2 points, but this is the one we had where it had that bank close and everything. I'm going to turn back on all the colors that we had, so it brings everything back on. Okay, so I'm going to take out this time sliced by color, and I'm going to add back in where resistance and support is. We're going to add those back in, and then what I'm going to do is turn the bars blue and red. Okay, where I can grab that. And blue means we're in an uptrend. Red means we're in a downtrend. Now, I'm going to delete off this drawing text. I'm going to go to Edit, delete all, and get rid of the drawing text. Okay. Now, what I want to do is I want to measure the frequency. I'm going to take a breakdown. Okay, I broke down. How often does it break down and then break back up? Break down and break right back up. How often does it do that? And without moving X amount of ticks. There's a good example right there. Okay, look, it broke down and immediately turned and ran right back up. Okay, that's one of the things I need to find out. So I'm going to come in here and I'm going to grab a little indicator, and this indicator looks for a specific pattern. It says this: if we go S2 to R1 to S1 and we trade above the high, tell me how many times that happened. We broke support, went above the high. If R2 to R1 and we break S1, how many times we go below the low? Out of how many times we broke out totally. So it's not quite finished. I got to make how many times it broke out total to give it to you, sum of this price. So this will, I have to just get total breakouts. So now I got to have 4 numbers here. I have to just say, well, when did I cross above resistance? Cross above the high, goes above resistance. Okay, R1, and I need to know that. And then we've got down here, we need to have the cross. Oops, we missed one bracket. The cross below S1, because this will give us our total events. So we're going to say S1 and low. S1 and low. Now, this is to emphasize a point that's going to come up with the money management stuff. So I'm going to bring this on, and I'm going to drop this on. We just want these numbers. Okay, the top number, we're going to total the two, and let's make sure I did everything right. It's 48 plus 30. Okay, and it's probably a little bit more complicated than I did it. 48 plus 30. That can't be right because it says 79. So let's go check our code right here. I'm going to put you on. Shoot, I can't do it in this software package. I was using it because it's really visual. I can't do it in here because of the eyes. It takes too much time to write it because there's an eye in there that screws it up. So we're going to count it. We're just going to count the number of times that it does this. So we're going to state that in the model we're going to take maybe a 1 range target on part of it. So the bars went red and I didn't hit my 1 range target. So that's 1 loss. And then I'm going to come back up here because this is what we're going to figure out. Okay, I'm good. I made my 1 range target. Okay, how often, we're counting how often it goes from red to blue, red to blue, red to blue. That's all we want to know is how often does it go red, blue, red, blue. Okay, that's what we're trying to look at. And you're saying right there, and not go 20 pips. Well, here, or not go a trading range. Here it went a trading range, it went red, you would have been out. Okay, here we take a trading range, and this is on the S&P. It's not very often that we go red, blue, red, blue, red, blue. Here's some real choppy, ugly market. Okay, here it went blue, here it went red, but it only has to go 1 range. So I'm going to stop this. I'm going to introduce the model on a different video, and because now I can bring all these things together, and I'll leave the one at time slicing. Thanks.